Welcome to Yahoo Finance Live. It's Thursday, February 2nd. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action. It's certainly going to be a busy couple of hours here on Yahoo Finance Live. You're looking at gains for the S&P and the Nasdaq. The S&P holding on to gains up just around 0.7%. You're looking at the Nasdaq outperforming the broader market there, up just around 2%. The Dow now in negative territory, off just about 230 points. We've got to take a look at Meta because that is a standout story of the day. The gains there up just about 23%, helping that sentiment around the tech sector there, Dave.
It is remarkable, Shauna. I would not have thought half that number. Solid report. Not spectacular. Let's get you up to speed now on the enormity of the reports we're about to unveil and analyze, though. 3 companies, nearly $5 trillion in market cap. That's trillion with a T. Apple, Alphabet, Amazon, all reporting after the bell in what is our busiest earnings day of the year. Investors are optimistic with all 3 up between 3 and 6%. Tech editor Dan Howley and senior tech reporter Ali Garfinkel here with one big thing from each of the big 3, Howley and Ali. Look, I need a name for that. I'll work
Hallie?
on it.
Hallie,
Howley, yeah.
Not bad.
Solid, good start. I will start with you, sir. Expectations for the big one, Apple.
Muted. We're expecting a decline, first decline since 2019 in revenue year over year. The big number that we're looking at is iPhone sales. Revenue there is expected to be $68.3 billion. That's versus $71.6 billion last year. And I think this is going to be the number that most people are looking at just because there's 2 issues at play here. One was the supply side. There were the issues at the plant in China where there were lockdowns due to COVID and worker protests. That impacted iPhone 14 Pro and Pro Max sales. And the other is on the demand side of things. Are consumers continuing to buy smartphones? The answer, I guess we'll find out. IDC was saying that there was a decline in overall user demand in the Q4 quarter. So Q4, that's Q1 for Apple.
Could be a disappointing report here from that tech giant. Ali, you are watching Amazon. What are you focused on?
So to me, Shauna, the real big question is, what does cost cutting look like for a company like Amazon? Yes, they've laid off 18,000 people, but what does it really mean for a company with its hands in so many different piles to be efficient? What is that story going to look like? Like if you think about Amazon Studios, right, their budget's already $10 billion. So what do cuts really look like here? The other thing too is Amazon is expected to report its slowest sales growth in 20 years today, slowing e-commerce services, slowing ads possibly. So what I'm hearing is that there's definitely going to be pressure on them to spin the cost-cutting narrative and figure out what that really looks like.
Looking forward to get a good look at the consumer there. And finally, let's talk about Alphabet. You know, I want to talk ChatGPT, but I'll let you guide us where you will, sir.
I don't think they want to talk ChatGPT
No,
at all.
they don't.
But they have to.
They do. I think, look, the revenue that we're looking at, expectations are relatively good. $63.2 billion versus $61.9 billion. That's ex-TAC. But I think what everybody is going to be looking at is what this means for the digital ad market. Sure, we got Meta yesterday. Everyone says, it's great news for Meta. Not really, because their revenue is down year over year, and the ad market, they admit themselves, is still difficult. Snap, obviously they're dealing with the difficulties from the ad market. We'll find out what's going on here with Alphabet and Google, especially YouTube, where we had seen a slowdown in ad sales. So I think those are the big questions that people are going to have. If revenue's up, that's all well and good, but what does this mean for the overall digital ad market?
All right, Alphabet, Amazon, and Apple all on deck. All 4 of us are going to be very busy here in just about 60 minutes or so. Dan and Ali, thanks so much. Let's get you up to speed on the fight against TikTok. Senator Michael Bennet demanding that Apple and Google, quote, immediately remove TikTok from the app stores. Now, the senator writing a letter addressed directly to Sundar Pichai and also to Tim Cook, calling TikTok's influence a threat to national security. Bennet is just the latest in a string of lawmakers fighting to ban the social media app. We spoke to Senator Mark Warner about this issue last November, and he explained his concerns. Let's listen.
I'm afraid how that information could be potentially used to leverage people's behavior, to expose things that are inappropriate, and just the same way we were concerned about a lot of our information being monetized or manipulated by Facebook. I think you ought to have those same concerns, and even more so when you're talking about TikTok.
Certainly a lot of concern there from inside the Beltway, Dave, just about the national security concerns that's posed by TikTok. We know the CEO of TikTok will be testifying in front of lawmakers next month. He certainly has an uphill battle there, convincing them that they should not be worried.
It's a lot like Ticketmaster when Richard Blumenthal, Connecticut senator, recently said, "Congratulations, Ticketmaster, you have united Republicans and Democrats." We're starting to see that with TikTok, where there is an emerging bipartisan consensus that it is dangerous. I do want to mention TikTok pushed back strongly on that letter from Senator Bennett, saying it relies almost exclusively on misleading reporting about TikTok. The data we collect are data security controls and ignores considerable investment we have made. They added on that they've spent $1.5 billion to really revamp their U.S. data security. I don't know that that'll do much to assuage these congressmen, but there's not a big enough group to make a lot of movement, to make enough noise yet. But it certainly is building. It's not like some of those stories that are beginning to fade. Consider way back when President Trump first proposed this, it has really climbed a mountain from then. Maybe if I am Meta, if I am Mark Zuckerberg, I am lobbying DC heavy on this, because if it is banned, boy, they had a good number yesterday and a great day today. If it is banned, sky is the limit for reals.
Yeah, certainly. It would be great news there for some of the competitors here in the U.S. We know that the concerns have prompted U.S. government to ban TikTok from official devices. More than half of the U.S. states have taken similar measures here. So those concerns are widespread. But Dave, like you were saying, until we see more Democrats coming over to the other side and agreeing with what we've heard from many Republicans, many of the GOP party, with their concern, voicing the concern about banning TikTok, or the reason to ban TikTok here in the U.S., it's likely that we won't see much movement on that front.
Really may come down more than Congress to the Committee on Foreign Investment, who really handles this. And when you step back and just look at how the Biden administration is handling issues like this, the momentum is all towards not necessarily breaking up big tech, but certainly trying to. We saw Lina Khan lose a bit of a case with Meta yesterday, but look at what they said about Google. They are trying to at least investigate the DOJ, whether that needs breaking up. All the momentum is against big tech as far as legislatively. All right, let's get you up to speed now on some other big movers today. Shares of two of the largest pharmaceutical companies, Merck and Eli Lilly, are falling after the companies reported their fourth quarter earnings. Yahoo Finance's Anjali Kemlani is here with the latest. Hello, my friend. What do we learn?
Hi. Well, let's start off with Merck, because that's, I think, the more interesting story. They have a lot of different things going on. Of course, with their earnings, we were looking at the impact from no longer COVID being a really important topic, at least for most of companies in that category for 2023. They also did have a little bit of pressure from a report citing some concerns about their COVID treatment, molnupiravir, and the potential for new mutations as a result linked to that. So the company has denied that, but it seems like that is something weighing on the stock as well. Meanwhile, they are also facing potential fall off of Keytruda. That's something that's still, on the radar for them in the outlook. Meanwhile, Eli Lilly, another COVID company, if you will, their monoclonal antibody totally took a hit, no longer an option, a viable option against these new variants. So some pressure came from there, as well as disappointing sales of their diabetes drug, which had a little bit of momentum and a lot of excitement around the potential use as a weight loss drug as well. But sales missed there, so there's some pressure on that stock as well.
We're looking at losses of just over 4% right now, with about 50 minutes to go until the bell. All right, Anjali Kamlani, thanks so much. Well, we are just getting started here on Yahoo Finance Live. Coming up, better than expected Meta earnings lifting the tech-heavy Nasdaq today. We'll talk about what lies ahead for the tech stocks. Mortgage rates falling for the fourth straight week. We'll talk to the chief economist of the Mortgage Bankers Association to find out where he thinks rates are headed. And get ready for an earnings avalanche after the bell. We'll bring you reports from Alphabet, Amazon, Apple, and more as soon as they break. Don't go anywhere.
At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%.
The Federal Reserve is raising its benchmark interest rate by 1/4 point, putting it in the range of 4.5 to 4.75%. The decision was widely expected by economists, and it's a step down from recent increases, since inflation is starting to slow and the Fed has decided it doesn't need to be as aggressive. But just because the Fed's tapping the brakes, that doesn't mean it has plans to pause rate increases anytime soon.
We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2%.
Today's announcement will have an impact on the U.S. economy and your bank account. First, the Federal Reserve's interest rate policy is tied to borrowing rates and made big waves in the housing market in 2022. Higher mortgage rates means higher monthly payments for people buying homes now. And since the central bank began lifting rates from its pandemic-era low, mortgage applications have seen a steep decline, plunging 40% in the last year. Second, you may have noticed you're earning more money in your savings account. That's because rising interest rates push up yields for savers, with some high-yield accounts now earning more than 3.5% annually. And last but not least is the Fed's ongoing battle against rising inflation. Chairman Powell reiterating the central bank will do everything in its power to fight rising costs, saying it won't stop until inflation is subdued. That'll be a relief if and when it works. In the meantime, the Fed's hikes are rippling their way through the economy and your wallet.
Let's take a look at the broader markets here. The Dow still in negative territory. S&P and Nasdaq, though, holding on to gains. Some of the gains being attributed to the fact that there is some speculation out there that the Fed may be nearing the end of its rate hikes. Also, the stronger than expected results from Meta last night helping to boost the Nasdaq today. We want to bring in Kevin Mon, Hennian and Walsh, Chief Investment Officer. Kevin, it's great to see you here. So we had the Fed raising rates by 25 basis points, largely expected by the street. Some commentary from Fed Chair Jay Powell. He wasn't really committing to the fact of whether or not more increases, plural, would be necessary. What do you think?
You know, Sean, I woke up this morning talking about what the Fed did yesterday and what the Fed may or may not do in the future. It felt like Groundhog Day, but I digress. I think what we learned yesterday in all likelihood is that better days are indeed ahead for the markets, because we received confirmation from Chair Powell that in all likelihood, we've certainly hit peak hawkishness, and by extension, we've hit peak inflation. As he mentioned the term disinflation 17 times during that press conference, where he didn't mention that word once during their December press conference. So I believe from here, we're likely to see one 25 basis point hike after their March meeting, and perhaps one more 25 basis point hike after their May meeting. And then they stop and assess the overall damage that they've done to the U.S. economy, which I would believe will be relatively significant.
The groundhog saw a shadow, I think, today, but he's never right. Do you think Jerome Powell does have this right?
Oh, that's a great analogy. And certainly he hasn't been right thus far. We remember back to early 2022, Dave, when Chair Powell suggested that in all likelihood they were going to only raise rates by 50 to 75 basis points last year. They raised rates by 425 basis points last year. We remember last year when he suggested that inflation was transitory. That certainly did not turn out to be the case. And then in May of last year, he suggested they weren't even considering rate hikes above 50 basis points. Then they hiked rates by 75 basis points 3 consecutive times. So certainly some credibility has been lost with market participants around the Federal Reserve. So that's why you really have to take all their verbiage with a grain of salt. But certainly inflation is beginning to moderate right now, and they have scaled back the pace and rate of their rate increments. And that's a positive for the markets, although I don't think better days are ahead for the economy, Dave.
Yeah, Kevin, how much worse do you think the economy could potentially get in terms of a recession? How severe could that be?
Well, fortunately, if in fact the Fed doesn't stay as aggressive as some had earlier thought, which it appears now as though they might not, this recession may not be too severe, or too long. But we're starting to see signs of distress amongst the consumer. Remember, Shona, that the consumer accounts for 70% of our economic growth in our country. We saw that retail purchases have now fallen in 3 of the last 4 months. We also saw that spending on services were relatively flat in December. That was its worst reading in over a year. And now consumers are starting to dip more into their personal savings and put more on their credit cards. How much longer can that last? And if the Fed is not able to get inflation back down to their 2% target, which I don't believe they will come close to this year, well, inflation is going to continue to take a bite into the consumer's wallet. So that's why I have concerns about the strength of the U.S. economy in the first half. I believe we'll likely dip into recessionary waters. But remember that markets and recessions don't always move in the same direction. And if you wait for the economy to improve, you may miss out on some of the best opportunities that the stock market has to offer.
If someone in our audience doesn't come up with a Punxsutawney Powell meme, you failed me. I do want to move on. Kathy Wood, ARK Invest CEO, joined the show earlier, sharing her thoughts on Powell's press conference yesterday. Let's listen.
I think the most important thing he said was that he agreed with Lyle Brainerd, who's saying we are not in the middle of a wage price spiral. And that's code word, I think, for saying we are not in a 70s style inflation.
Your reaction, Kevin?
Well, we've had, what is it now, 15 consecutive months of higher inflation. Inflation getting back down to a 2% target. I think the Fed is going to start to ease up on their target forecast for inflation as inflation remains stubbornly above 5%. And they can only have so much control over bringing down inflationary pressures. They're trying to cripple demand, and they've actually succeeded to a large extent based upon some of those numbers I spoke about with respect to the consumer. But for investors, Dave, there are opportunities now to position your portfolio for those better days that are ahead for the markets. Certainly, we got off to a great start thus far this year, perhaps too great. But areas that have been really beaten up in 2022, some of those technology areas, consumer discretionary. We saw Amazon was down by over 50% last year. Now it's made back about 25% this year, perhaps too much and too fast. But those are the types of names that could do better towards the second half of the year when the Fed does pause or stop their rate hike cycle. But don't abandon quality in your search to try and catch up to that rebound. Look for those companies with strong balance sheets, those that pay dividends, and are also in some of those more defensive sectors, and balance that with some of those beaten up technology and consumer discretionary names.
Excellent tips there, sir. Great to see you as always, Kevin Mon. Appreciate that. All right, coming up, layoffs, higher interest rates, higher prices, all starting to take their toll on the U.S. consumer. Now some Americans are starting to tap into their 401ks to make ends meet. We'll tell you what new data shows after the break.
Brian Stassi here with Brad Smith, and we're getting ready for our After the Call on Apple earnings, which hit on Thursday after the close. One big number I'm watching is the stock price. Apple stock is up 11% year to date on a lot of hope and optimism. Brad, what you watching?
I'm watching services. I'm watching where those iPhone shipments are actually netting out. So keep a close eye on everything between those products and services, but specifically on that iPhone because it makes up the lion's share of that Apple revenue base.
Are you excited to hear Tim Cook's voice?
Always.
Always.
It's so soothing.
It really is. Me
it's
too.
Like butter on a croissant.
That is a perfect way to put it. All right, after the call, Yahoo Finance, check it out on our homepage. We'll be live right after that Apple earnings call ends, a little after 6 o'clock. We'll also be live on YouTube. Watch it, bookmark it, you name it.
Mortgage rates continuing to fall. The average 30-year fix sliding to 6.09% from 6.13%. That's according to Freddie Mac. Now, mortgage rates do not move directly with the Fed's interest rates, but more in line with the 10-year. But certainly notable that Jerome Powell indicated Wednesday, quote, "Given our outlook, I don't see us cutting rates this year." Mike Fratantoni is the Mortgage Bankers Association chief economist. He joins us now. Good to see you, sir. So that rate, I think a pretty notable move down near that 5 range. But given what the Fed chair said, how low do you think rates will get this year?
And so we're forecasting that we're going to be closer to 5% than 6% by the end of 2023. As you noted, the Fed, we think, still going to push up short-term rates at least one more time, one more 25 basis point hike. But long-term rates like 10-year treasuries, 30-year mortgages, already reflecting the weakness we're seeing in the economy, and honestly reflecting the fact that at some point the Fed will reverse course and begin to drop rates.
How low do you think rates need to drop in order to spur a lot more activity in the housing market? Because still, even though we have seen some improvement, we know sellers and a number of buyers still remain on the sideline.
Yeah, it's been interesting. You know, fourth quarter of 2022, the housing market, I think, was just dead in the water. And you look at the level of activity right now, it's still very low. You know, applications to buy a home still about 40% below where we were last year at this time. But we're beginning to see an increase in the level of activity, and that's in our data in terms of mortgage applications. It's in pending home sales from the realtors, and it's in builder sentiment from the home builders. So everything pointing in the same direction. The January a little bit better than that extraordinarily slow fourth quarter from last year.
Is the worst behind us, Mike? Excuse me.
Yeah, I mean, we were above 7% for a 30-year mortgage rate in fourth quarter last year. And now, like you said, you know, last week we were a little above 6. And some of the data in the market today saying a lot of mortgage lenders are quoting rates that begin with a 5. So I think that's going to be enough to get potential buyers much more interested in out looking for properties.
Mike, what about the state of the economy right now? Because that remains uncertain. If we do see a recession, how do you see that impacting housing over the next several months?
Yeah, that is our baseline forecast. So we think we're going to be in a recession the first half of this year. The unemployment rate, which was at 3.5% in December, we see getting above 5% by the end of 2023. And that's going to be a headwind, certainly, but a benefit, again, particularly for that first-time buyer, is rates down from 7 to maybe the mid-5s. Home prices, instead of growing double digits, we think are essentially going to be flat for much of the next 2 years. So from particularly a first-time home buyer perspective, the market's a bit more inviting. They might actually see some additional properties out on the market, particularly in the new home portion of the market. We've seen inventory pick up. In terms of existing homes, inventory is actually still quite tight. And a lot of current owners, if they don't have to sell into this somewhat weaker market, they may just hold on to their properties for a bit longer.
Historically speaking, where are those inventory levels, and when do you believe that story begins to change?
Yeah. So again, different on the new versus existing side. New home side, there's about 9 months of supply. A lot of that are homes under construction, and we expect that builders are going to be forward-leaning in terms of, you know, offering incentives and in some cases price cuts to move those homes. But a builder's in a different position from a current owner. Homeowners in the U.S. in the aggregate have about $30 trillion of home equity right now, and millions of them are sitting on mortgages that were taken out at all-time lows, 3% or even lower. So we have less than 3 months of supply on the existing side. So if you're a buyer, probably more opportunities to see in the new home market than the existing home market right now. You know, 6 months of supply is typically what you think as a balanced market. Again, new home market looks like we got more than that, existing a lot less.
Mike, you mentioned the fact that some buyers are coming back into the market. How much leverage do buyers have today?
Well, certainly a lot more than they did last year at this time. Last year it was all about, you know, multiple bidding wars and properties going for well above list price. You know, now it's just not the same level of fever in the market. So, you know, I think a buyer has a lot more leverage. I wouldn't overstate that, though. Again, given the lack of inventory on the existing side, if a current owner is not in any way distressed and doesn't have to move, you know, they may not give a lot on price, but there may be other options available. You know, you see many sellers perhaps they're going to offer to buy down that buyer's mortgage rate for a period of time. That certainly happens in the new home market. So it's not all about price and negotiating around price. There are other terms of the transaction where a seller might be more flexible to get the property sold.
Mike Fratantoni, Mortgage Banking Association, a chief economist. Thanks so much. All right, well, more Americans are taking cash out of their retirement accounts. That's according to a new Wall Street Journal report. Vanguard Group saying that 2.8% of its 401k customers have withdrawn money last year. That's up from 2.1% the year before and 2% before the pandemic. Stubborn inflation has many households really feeling the pinch and struggling to cope with hardships and even regular expenses.
Retail purchases have fallen 3 out of the past 4 months, and spending on services were flat last month. Personal savings have plummeted from their pandemic highs, dropping to 3.4% of monthly income in December. That is down dramatically from 7.5% a year earlier. With consumer spending being the backbone of the American economy, it's not looking good for those hoping for a so-called soft landing. I'm going to hold out hope, but that initial number that you discussed, 401ks, continuing the last 2 years to dramatically increase, it is twofold reasons. Now, we did loosen up the rules and regulations surrounding that withdrawal process in 2018. It is easier now, but still, largely speaking, you're going to pay your taxes and you're going to pay a 10% penalty if you are under 59.5. But people are now pulling out their 401ks for foreclosures, to avoid foreclosures, for medical procedures, to pay tuition. That number is greatly concerning when it comes to the overall health of this economy. As concerning, I think, is that personal savings number, 3.4%. Almost half of what it was a year prior.
Yeah, 3.4% Americans are saving 3.4% of their monthly income. Really just illustrates the fact that not many people have the extra cash around. They really are closely living paycheck to paycheck. And we just heard from Kevin Mon earlier in the show talking about inflation and how he expects it to continue to take a bite out of the consumer's wallet, continues to think that consumers will be paying higher prices now for quite some time because he's not confident that the Fed's going to be able to get that inflation rate back to 2%. So certainly consumers are in a tough spot right now. We talked about the fact that we are at risk of heading into a recession. So that whole scenario, the whole landscape right now for the consumer might not improve anytime soon.
Yeah, economists still tend to lean 60-70% towards a recession, some type of mild recession this year. Although just about every earnings report we discuss, the CEO, with I think the notable exception, early on we talked about the big banks. Yeah. And most of those CEOs said they do expect some type of mild recession. But once we turn the page from the big banks, we've heard relatively nothing about predictions of recession. I think UPS did think they see one in the first half of 23 with the bounce back late in the year. But earnings report after earnings report shows the consumer is holding up better than some of these numbers would suggest, and especially when you look at the labor market, 50-year low unemployment rate, and I'm guessing it's going to hold right in that range on Friday. I'm no economist, just judging by the earnings report. I think we get through it.
Yeah, we'll be interested to see how much power, though, a lot of these consumer-facing brands will have in the coming quarters because the fact that people are paying more and more. And we're starting to see some consumers resist higher prices. They simply aren't spending on some of those essentials that they had been spending on over the last several quarters, over the last 2 years, because it simply is getting too much. Some of these price hikes, Procter & Gamble raising prices by about 10% here. Not everyone can afford these types of prices on everyday items. So we will see, but you are right. A number of CEOs have come out in their earnings report saying that they are not seeing any signs of a recession within their business.
McDonald's raised their prices 10%
and
as
people
well,
are willing to pay
and
that.
Put up some big numbers. Coming up, GM and Netflix are teaming up for Super Bowl 57. Find out why next.
It's time for a triple play. 3 stocks that we're watching the final 30 minutes. We've got Hanes Brands, Penn Entertainment, and GM. My pick, Hanes Brands, a t-shirt underwear company. I'm sure you're familiar with it. Well, look at that. Shares are plunging today, nearly 30%, the biggest sellout that we've seen in this name in about 15 years. This comes after eliminating its quarterly dividend, also issuing weak guidance. The company warning about consumer spending and expected demand to be muted given that macroeconomic uncertainty. For the fourth quarter, sales fell about 16% as retailers cut orders due to inventory positions. Obviously, a tough environment out here for Hanes Brands. He's still got one fan over there, Dave, who, if you saw me laughing during it, it was because he was slowly unbuttoning his shirt to show off his Hanes Brands t-shirt.
Is it even a Hanes shirt, Dave?
This is a Hanes shirt.
It is a Hanes shirt.
This is a Hanes shirt. V-neck, love the Hanes. Probably have about 30 of them. I got to recycle them like every week because I sweat lots. Anyway, let's move on.
Well, Dave, I'd asked you earlier, though, and it was interesting because he didn't know if it was a Hanes shirt. I feel like a lot of people don't know.
Do you wear them?
I don't wear Hanes. I wear Amazon, which I was going to bring up as maybe a reason why Hanes has been struggling to some extent.
Yeah,
I have now switched because he told me Amazon made t-shirts, so now I'm in.
Oh, well, you guys are ditching Hanes. This is part of the problem. It's why the stock might be off 30% today.
Yeah, it was something that I've been looking at, though, when you look at Hanes' performance quarter over quarter, right? This has been a consistent performance, consistent drop. You look at their gross margins. You go back to Q21, 2021. They had gross margins of 40%. That's down to 34% now. So they really are getting squeezed when we talk about the business. And you take a look at that year chart there, down almost or more than 60% over the last year, guys. And my stock today, my play, is also down. Penn Entertainment, shares falling a little over 6% with the gambling operator reporting earnings that missed Wall Street estimates prior to the opening bell today. Now, Penn posted earnings per share of 13% versus a street estimate of 42 cents. That marks the 5th time in the last 8 quarters that Penn's earnings per share has surprised the street to the downside. But still, a few bright spots to point out here. Penn still plans to close out its purchase of Barstool Sports on February 17th. Penn says adding that Barstool posted record revenue in 2022. CEO Jay Snowden saying in today's release that Penn and its other digital arm, the Score, will, quote, provide us with compelling competitive advantages in organic cross-selling opportunities. So Penn clearly still relying on Dave Portnoy and Barstool Sports to drive that digital sportsbook strategy that we talk about. Dave, one other graph I want to pull up here, though, because we've talked a lot about is gambling recession-proof. So what you're looking at is a graph from 2007 to 2012, and it's regional markets, regional casinos versus Las Vegas casinos. You see Las Vegas casinos really fell off and didn't recover quite as quick the last time we had a deep recession, but regional markets did. Penn pointed this out today in their earnings because Penn's a very heavy regional operator. And I think that'll be curious. We're talking about a different time, obviously.
Thank you. We were in a dramatically different time in terms of sports gaming and gambling.
Right, no, but that's in person.
Apples and
that's
bananas.
That's brick and mortar, though.
Yeah.
I just think it's interesting to see Vegas fall off to that deep extent.
Yes.
And will that travel fall off again this year when we think about 2023 and the overall casino level?
Reminiscent of when the Foxwoods CEO came on here and said gambling is not recession-proof. He is fearful. But look, the sports gambling stocks have had a terrific start to the year, a lot like the tech sector. DraftKings up more than 50% year to date. My play is GM, General Motors, riding shotgun with Netflix and a new Super Bowl marketing campaign starring Will Ferrell. The ads focus on the GM EVs as they drive through various Netflix shows such as Stranger Things, Love is Blind, and this one, a Squid Game themed teaser rolled out today.
We all wear masks. Does that resonate with you?
Yes, it does. Terrific ad. GM will run a 60-second Super Bowl ad that, based on publicized rates, would cost between $12 and $14 million just for the one ad. This is the beginning of a partnership that should see more GM EVs popping up in Netflix original series. The streamer had already committed in 22 to put at least one electric vehicle in every series or movie it directly produced. GM shares surged on a strong earnings report this week. Another big move to the upside today, up almost 5%. And it is just rocking this year. And today we'll get Ford earnings after the break and break those down. But it should be an interesting team up collaboration in that Super Bowl ad. I think a terrific idea.
It is a terrific idea, and GM needs to do something, right? Just in terms of wider adoption of EVs. We know automakers, they long have wanted to place their vehicles in hit shows, in hit movies. So this makes sense on GM's part, because when you take a look at some of their lofty goals here, they're planning to introduce 30 new EVs by 2025. So they need more of that wider adoption there. When you take a look at the sales of EVs, yes, they are increasing, but still less than 6% of the total market share.
Right, and the Super Bowl is a great time to do it, right? You're going to get a massive audience. Obviously, the ads are expensive. We're going to talk about that a lot over the next week. But you really do get different people to see your vehicle. And I think realize sometimes that GM is making EVs. Ford is making EVs. I think a lot of the general consumer is still focused on Tesla to some extent when we talk about EVs.
Great point.
Yeah, they certainly are. All right, well, we are going to stick with EVs, with autos, and could we be headed toward an EV price war? We will take a look at the fallout from Tesla's big price cuts after the break.
Welcome back to Yahoo Finance Live. Expectations are high for Ford ahead of earnings, which report after the bell. We just heard from General Motors earlier this week. The company handily beat Wall Street expectations, said it has no plans to cut prices on its electric vehicles yet. So what lies down the road for the auto industry? Let's talk about that with Edmunds Executive Director of Insights, Jessica Caldwell. Jessica, nice to see you. Ford out with their sales numbers down 18.4% from the prior month. Now, January is usually a rough month for auto sales, but does that tell you perhaps that 2022 dynamic has changed this year?
I don't think so. December is generally the best month for auto sales. January is usually the worst. So I would never really compare those two. And I think that for 2023, inventory is still going to be the name of the game. As that increases, sales should get better because they are very limited. I mean, we're still, although recovering and have been for several months now, still very much down from what we would consider at a normal pace for inventory.
Earlier today, Kathy Wood was on Yahoo Finance. We know, obviously, she's a longtime believer in Tesla. We asked her about the recent price cuts. I want to play a quick bite from her and then get your reaction.
I think traditional auto manufacturers are going to have trouble keeping up with the price declines that Tesla's technology is enabling.
Do you agree with that?
I mean, I think right now that probably is the case. Tesla is still almost 60% of all new EVs sold. So in any event, they're going to be something big to contend with. As time goes on and more of these automakers are introducing EVs, especially if we do not get some updates from Tesla, having the Tesla is no longer the latest and greatest thing, and there'll be more to out there in the market, more to compare it with. Someone else is going to come along and be the cool new person on the block, and that really appeals to early adopters. So while I think they are obviously a big force to deal with in this market, things are changing.
GM really, as we said, took a pass on following in those price cuts. Do you think those price cuts from Tesla will spread throughout the industry, or others will more follow GM's lead?
I don't think so. I mean, I think price war is a real sexy thing to say. However, there's just not inventory to have a price war. I mean, if we look at what General Motors has, there's really not a lot there. There's a Bolt, there's a Hummer, and what they have coming this year that is even in the realm of competing with the Tesla Model Y, it's new and it's probably going to be limited by inventory. So I don't think that even the price cut probably doesn't even need to be addressed there. I think Ford, the Mustang Mach-E being a natural competitor, something that's been in the market for a little while, to the Model Y, I could see why that would make sense. But even those price cuts were not necessarily very dramatic across the board. There were a few trim levels. But I do think that automakers will be looking at their pricing strategies and making sure that they could come in, or have some models, if possible, to come in within the federal tax credit limits.
Jessica, what are you seeing in terms of traffic on Edmunds? We just had a few numbers up there, but overall, after the price cuts from Tesla, how much did some of that interest, did that demand spike on your site?
It definitely spiked a lot. I think whenever you have someone like Tesla, and the thing about Tesla's announcement was that it was very atypical in the sense that incentives are usually very targeted. When they come out and you say something like 20% for every vehicle, every region, that applies to everyone out there versus a specific location, a specific vehicle, a specific trim level, which is very different. So we saw the traffic pretty much double in terms of Tesla's share on our site as people were thinking, wow, maybe now is time to get a good deal. Let me research that.
As people do begin to look for new models, in particular in the EV space, you have some advice before they begin that process. What is it, Jessica?
Well, I mean, I think pricing obviously is a big one. Do the vehicles fall within these price limits? Because we do know that in March, the IRS is likely to issue guidance on mineral components, battery components, and that could change that strategy. So if you are in the market in the short term, I think you really have to think about what's out there. Can you still get that credit? And I think that would be really important. And another thing to keep in mind is really interest rates. Those are going up. In the fourth quarter, people were paying, we're closing in on 7% interest rate on new car loans, which is obviously crazy because they've not been that high in quite some time. And you really have to factor that in when you are considering that most vehicles at this point in time are, they're transacting at over $40,000. So a lot of money we're talking about now.
Jessica, if you're one of those Tesla owners, you're a little bit upset because you bought before the price cuts. What's your advice to those people? Should they hold on to their Teslas?
Well, I think that, used values, of course, it doesn't feel good for that to happen, but it's only going to affect you if you want to sell it soon. So all those people that were thinking, let me buy this vehicle and flip it, which we saw a lot last summer when used values were just going, off the charts. Hopefully people are not doing that come December. But if you are one of those people that just bought a Tesla, if you're going to drive it for many years and, keep it for a long time, these price cuts shouldn't affect you too much. It's just, I think if you were going to sell it in the short term, that probably wouldn't be a great idea. So keep and hold. I know it doesn't sound as fun, especially as these people, are generally want something probably every, in a faster cycle than the norm. But I think that probably would be the best way to mitigate these price cuts.
Jessica Caldwell from Edmunds, thanks so much. Coming up, Netflix has started enforcing its password sharing crackdown, but you don't need a password to learn all the details. We have them for you next. From the tweet that didn't age well file, here's a beauty. Love is sharing a password. Netflix sent that out nearly 6 years ago, and now it seems the company has had a change of heart. The question for Netflix now is, do you love the streaming giant enough to pay for your own account? Netflix has begun enforcing its no password sharing policy by officially updating its help center for countries currently in the crackdown zone. That's Chile, Costa Rica, and Peru. But the U.S. may be up next, so pay attention to these changes. Sharing your Netflix account with someone outside your household will get you on the naughty list. Users will be asked to identify the primary location for the account, and you'll need to sign into your primary location at least once every 31 days to keep that setting up to date. Now here's where it gets stickier. If someone logs into your account from a device not affiliated with that primary location, their device may be blocked. If you're traveling and you log onto your Netflix account, you can request a temporary code and watch Netflix for 7 consecutive days. If your trip is longer than 31 days, you'll need to update your primary location. Getting heated yet? I am. Netflix will be using IP addresses, device IDs, and account activity to determine if a device is connected to your primary location. The policy is indeed good news for Netflix and its investors, as the company is said to lose around $6 billion a year on customers who share passwords. The added revenue only strengthens its case as the clear streaming leader.
I think Netflix is the Kleenex of streaming, bottom line, period. Best run, cash flow, now they're going to advertising. Fantastic. They will be the core.
Don't disagree with that, but how this policy is received in the short term will fall somewhere between Southwest Airlines holiday meltdown and the Taylor Swift Ticketmaster debacle. Yes, the vast majority will shake it off, but brace yourselves for, pardon a second Swiftie reference, bad blood. Parents with kids in college, pay. Kids at boarding school, pay. Kids studying abroad, pay, pay, pay. Couples who have long-distance relationships, you pay. One that, at its surface, is simple as a red light, green light game. Once you dig below the surface and see how this will become a constant annoyance for many of Netflix's 220 million subscribers, you can see this is actually more of a Squid Game red light, green light, because there will be casualties, much like in that show. I will be one of them, I guarantee it, because I think the constant annoyance, Shauna, of logging on, logging off, getting locked out of your account when your kids might be gone. My wife travels without me with the kids sometimes. They're going to get logged out. I love Wednesday, but once I'm through with it and this annoyance starts, adios. Your thoughts?
Yeah, I totally agree. I think they are going to lose a number of subscribers right now because of the crackdown, but they simply don't care. They see it being a bumpy ride, at least in the near term, but long term, they actually see an improvement in engagement. When you take a look at a number of the analyst notes that have been out there, Cowen saying that they think it could add about $1.6 billion in global revenue once they have a widespread crackdown on password sharing. 100 million households, they estimate, share passwords.
I'm not going to disagree with
that.
Cowen. I'm just saying, if you don't have sticky content,
oh yeah, people are leaving.
Then it will hurt. Wednesday's fantastic, and some of the hits they've produced are certainly, but you better continue a steady stream of sticky shows or people will not return.
And you need to, just given the sheer competition out there, and people have so many other choices at this point. All right, well, coming up, we are counting down to the closing bell on Wall Street. Stick with us.
All right, just a couple of minutes away from the closing bell. Brad Smith is in the house for the next hour. Very excited about that. Jared Blickery here to break down the market action. Little known fact.
Yes.
Does not pay for his Netflix account. They're coming for you, brother.
You know, thank you. Thanks for outing me, which I've done on this very show, by the way. Yeah, you want my renewal bucks? They don't exist. All right, let's take a look at the market. The outperformance this year by the Nasdaq continued. It is up 3%. The Dow is down a whopping 15 basis points. Not a big deal, but it just goes to show you that this year is definitely different than last year so far. Communication services, guess what? That is the Meta trade. We're going to be looking at the Alphabet trade and the Apple trade after the bell, but also consumer discretionary and tech are really outperforming. Haven't seen XLC with a 6 handle in some time. Real estate also outperforming, and guess what? Energy leading to the downside. That's down 2%, but the Nasdaq says it all. This is the Nasdaq 100 components. You look at Apple, all right, that's up 3%, Microsoft 4%, Amazon and Alphabet 7%, Meta 23%. Let's just take a look at a 2-year chart here so we can see the record high. Now, Meta is still pretty much in the bottom end of the range, but this is a pretty healthy, nascent rally. Let's take a look at the 2-minute chart here. 2-month, 52%.
And that was a closing bell on Wall Street, ending the day mixed. The Dow in negative territory, off just about 39 points. S&P, though, holding on to gains up just about 1.5%. The Nasdaq, the outperformer of the day, rallying in the final hour of trading, closing up just about 3%. Well, we are just minutes away from the biggest earnings releases of the season. We have Amazon, Alphabet, and Apple all set to report results this hour. Our very own Brad Smith is along for the ride. We called in the big guns for this today. Plenty to get into with all these companies set to report. I want to start with Apple because this is just going to be huge for the street. I think the big narrative, the big story here is all about demand, what those iPhone numbers sales are going to look like, if in fact we will see that year-over-year drop. Of course, we are expecting a year-over-year drop when it comes to revenue there. That would be the first that we have seen at Apple in nearly 4 years. So certainly a lot of attention on that name here after the bell, Dave.
All right, you're 2 Philadelphia Eagles fans, so I'm going to speak to you in that language. I'm not all that concerned about this report for Apple. Why? I think it's a lot like the Eagles playing Washington in mid-November and losing at home, and their fans are freaking out. They're not going to the Super Bowl. The shine has worn off. This is one quarter. We already know their struggles came in China during COVID lockdowns. They've largely already reversed themselves. Not all that worried about it, guys, because they're still going to the Super Bowl.
Well,
they're still winning a ring.
Since you're not worried about them, let me take your attention to Alphabet or Google or Alpha Google, whatever you're calling them at home. Here's what to look out for here. And the options market's pricing in about a 5% move here. So we'll kind of track up against that barometer. But again, this EPS number, $1.20, that's what we're expecting according to some Bloomberg estimates. Revenue expected to come in at $63.2 billion. And that's X the traffic acquisition cost. So keep a close eye on that figure particularly.
I'm most excited for Amazon in particular because I think this will give us the best look at the consumer. We are expecting the slowest sales growth in more than 2 decades. How is their cloud product continuing to grow? And we'll really get a great look at how tight the holiday sales were, how their margins were. This is the best of the 3 in terms of a look at the consumer, Shauna.
All right, certainly will be. Well, the S&P closing up just over 1% today ahead of this afternoon's earnings reports. For a broader look at the market, let's bring in Jim Schmigel, SEI Chief Investment Officer. Jim, we are in the thick of earnings season right now. Some of these big tech giants reporting as we speak. What do you make of where we stand today?
Good to be with you, Shauna. Today it is quite the day. If I would have read the nothing but the transcript from the Fed meeting yesterday, I would not have guessed we would be seeing some of the numbers that we're seeing today. The market just does not want to believe that the Fed is going to continue to be hawkish and remain hawkish, and we have multiple price cuts baked into the cake here by the end of the year, and we're seeing that play out. I mean, all the numbers that we saw earlier on the screen, Meta up 20%, good old AMC up with a 6 handle as well. I mean, this is really quite the rally. Can I call it a junk rally? I probably would call it a junk rally at this point. Too much disconnect, quite frankly, between what's happening with monetary policy and what the market's interpretation of that is right now. we're a bit befuddled.
Is it a rally that's built to last?
We don't think so. We're going to fade this. This is not something that we see a whole lot of fundamentals behind it. You mentioned the earnings that are today. The earnings have been kind of downgraded. We're going to be focused on guidance for sure. That's going to be the important part. But it all comes down to this one fundamental question this year, which is a pivot or a pause. We're going to take the Fed chairman at his word. We think that they're putting a lot of work in to get Fed funds at to that 5+% terminal rate. We think they're going to stay there. We think they're going to stay there for a while. And the markets are just too priced for perfection. Nice soft landing. We just don't see that happening in 2023.
All right, Jim, apologies to jump in here, but I want to break Amazon's results, reporting fourth quarter sales that beat the street's expectations, $149.2 billion. That's up 8.6% year over year. The estimate out there was for $145.8 billion. When it comes to AWS, that was a very closely watched metric here in this report, a bit light, $21.38 billion. The estimate out there was for $21.76 billion. That could be why we're seeing some pressure on the stock here in extended trading. Online store sales, $64.53 billion. That's off about 2.3% year over year. The estimate out there was for $65.03 billion. Taking a look at some of these other numbers here in terms of where they are seeing sales headed in the current quarter here. They forecast net sales in the current quarter to be $121 billion to $126 billion. The estimate was for $125.55 billion there. So pretty much in line with what the street was looking for. But again, we are seeing the sales or the stock off just about 1.5% in extended trading.
All right, so that is Amazon. Now let's pivot and take a look at Google. Alphabet earnings, of course, the parent company of Google, they are out, shares reacting positively as of right now. Here is what actually came in. You saw revenue come in at $63.12 billion. That's just a slight miss versus the $63.2 billion that was expected. And then the total revenue, that's the ex-traffic acquisition cost revenue that I just gave you. The total revenue that you're going to see as well within this report, $76.05 billion. So that gives that total acquisition cost, or that traffic acquisition cost rather, of $12.93 billion here. And then just lastly, the operating margin that I'm looking at as well here on the screen, it looks like that operating margin came in at around 24% for the most recent quarter. The street was expecting about 23.79, so we'll call that in line. But as of right now, taking a look at shares still, they were reacting positively as of right now, pivoting a little bit lower here and perhaps on some of those misses, higher than estimated, or bigger miss than estimated, I suspect, on the revenue side is what's really being priced in here. Going to continue to dig into some of these results. I also noted YouTube revenue. That came in at $7.96 billion for the quarter.
You can see the shares off just about 2.5% right now for Alphabet. Well, coming up, our earnings roundup continues. Ford, Starbucks, Qualcomm, all reporting. We've got everything you need to know on the other side of this break.
Let's take a look at where tech stocks are trading after earnings that just dropped for Amazon and Alphabet. Let's begin with Alphabet, parent company of Google and YouTube there. And for the revenue side, you saw that come in at a consolidated revenue level of $76.05 billion. The ex-traffic acquisition cost revenue was $63.12 billion. Earnings per share, that came in at $1.05. And so the company missing essentially on some of the estimates, both top and bottom line here. However, the traffic acquisition costs were just a little bit lighter than the street had been expecting. It was expected to come in at $13.2 billion, came in at $12.93 billion. And the margin was largely in line, just slightly outpaced by a hair on the chinny chin chin. And so continuing to kind of look through some of the other parts of this business. And this is largely an ad business, let's remember. And in an environment where there is so much of the pullback right now in demand for advertising, the larger question is, where does that duopoly in digital advertising continue to hold up between Meta platforms and a Google if people are seeing, or companies are seeing, the highest conversion rates or biggest bang for their buck in that spend?
What do you expect that investors in particular are reacting to, given that number we see about 4% down?
I think it is just the response to the environment that they've had to wade through in the most recent quarter. There was a lot of kind of investor sentiment coming into this around whether or not that the fourth quarter would actually set the bottom for the expectations in the digital advertising market. So all that to say, is the worst behind us with regard to the demand cycle right now? And
is that your expectation? I would assume not.
Well, here's the differentiator for both of those companies too. In what I just mentioned, in them being a duopoly in digital advertising as well, that's where they're able to offload some of that inventory into a YouTube. They can offload that inventory for Meta platforms into an Instagram. And so for all of them, having more of the reactive marketing campaigns that are able to take place, more conversion is what some of the marketers depend upon when they come to these platforms.
Yeah, certainly. And let's take a look at Amazon, because we're now looking at broader losses here in extended trading, off just about 3% right now. I mentioned the fact that their sales number did beat expectations, but net income, it was a miss on that in terms of what the street was expecting to see. Some of that valuation markdown of Amazon stake in Rivian is to blame there. The company taking a $2.3 billion pre-tax hit. Amazon owns about 17% of shares there. Also AWS, we know that was a focal point in this report. Revenue there, $21.38 billion. Yes, that's up 20% year over year, but it did slightly miss the street's expectations there. And of course, this follows what we heard from Microsoft last week, their Azure division, their disappointing results from cloud. And of course, we saw the reaction in Amazon stock after that report. Will be interesting to keep an eye on Microsoft this afternoon here in extended trading. But again, it looks like the street isn't too happy with these results when you drill down into that net income miss, and also the fact that AWS revenue coming up just a bit light there.
It's still an AWS story. We expected some slowing cloud growth. 20% ain't bad, but not when you're used to a far larger number. Can't help but wonder if more layoffs are going to be mentioned. A lot of attention on the 18,000 layoffs there at Amazon. You got to remember, they increased headcount 800,000 from 2019 to 2021. So will they find a way to cut expenses?
Yeah, and so many different businesses that are accounted for within Amazon, whether it's the e-commerce front or whether it is that Azure and web services front as well here. Let's switch gears briefly and talk about the brand of the green siren. Starbucks is out with its first quarter earnings. Our own Brian Sazi, he's sipping on coffee 24/7. He's got the numbers for us. Brian.
Hey, Brad, so nice to see you in the afternoon. Always a pleasure being on with you. I'm going to write this headline very simple for all you SEO friendly people out there. From left to right, Starbucks stock price for perfection, dash, dash, dash. Here's why they need to deliver. A couple red flags in this quarter. First up, global same-store sales up 5% year over year. The estimates were for an increase about 6.8%. Oh, yeah, they also missed on earnings by 2 cents. The problem here, I think, and this is why the stock is selling off initially after hours and why the current quarter missed, it was China. Same-store sales, I'll just say it, guys, they just crashed, down 29% year over year versus estimates for a decline of 13.3%, in large part because of the just the chaotic reopening of the Chinese economy, of course, impacting China. Also, another disappointing area for this quarter, operating margins 14.5% non-GAAP basis, 14.7% estimate. So lots of disappointments in this quarter. I think the street is playing off of those disappointments instead of what Starbucks said. They are reiterating their guidance here, guys. And I think that guidance really reflects their hope and belief on two things. First up, that the Chinese economy rebounds later this year and same-store sales ultimately increase off of easy year-over-year comparisons. And number two, there is no U.S. recession in the U.S. and consumers continue to pay higher prices for their various cups of coffee. But to that point, I will note within that global same-store sales estimate, transactions were down 2%. Transactions down 2%, telling you there are some consumers out there balking at these higher-priced coffees Starbucks starting to shove down your throat.
I know you like the Trenta, right? That giant jug of coffee. The expectation was...
I'm a buyer.
The expectation was better numbers
I don't care.
in China and a bit of a pullback here in the United States. That's what analysts were expecting. Was the bigger disappointment here or China?
China by far, Dave. Sure, the market understood that Starbucks and a lot of brands like it, like a Yum Brands, all these companies with outsized exposure to China, thousands of stores in this country, are going to see same-store sales declines. But still, in that initial couple minutes after an earnings report, to see a mighty Starbucks, which has relied on China for years to help propel its growth, to see same-store sales just flat out crash 29%. I mean, that's a lot for, I would argue, an already nervous market to take. Now, of course, there'll be more updates on this Starbucks earnings call very shortly. They will go into greater detail in that outlook that they reaffirmed. I am not a fan of a company not putting their full outlook on their earnings press release. The Starbucks is doing this yet again. They make it into the earnings call. I wish they would just give me the numbers on the earnings press release. Nonetheless, we'll be on that call.
All right, get another coffee, brother. You a cold brew guy?
I am a cold brew, and I was hoping to actually come on, Dave, and see you with no shirt again. But you know what? We all have wishes. We all have wishes. Really like that segment.
Sorry to disappoint, my friend. Good to see you, Brian Sozzi. Thank you so much. Your turn next time. All right, Ford also out with earnings. Proud Supermanian has them for me. It was a huge report for GM earlier this week. Does Ford follow suit, my friend?
Well, you can see the shares there trading pretty low, lower here after hours. Mixed results with a revenue beat, but an EPS kind of miss. So revenue $44 billion here versus $39 billion estimated. Adjusted EPS was a miss, 51 cents versus 62 cents estimated. Adjusted EBIT, $2.6 billion for the fourth quarter versus $3.45 billion estimated from the street. Also, guidance for the full year, looking at $9 billion to $11 billion versus $10 billion estimated. So that's kind of bracketing that estimate there. Ford said its operating results were below expectations. Though the company is optimistic about 2023, Ford CEO Jim Farley said in a statement, "We should have done better last year." He said, "We left about $2 billion in profits on the table that were within our control, and we're going to correct that with improved execution and performance." Like I said, the guidance for 2023 was in that sort of range, so that's actually a good point. What to watch on the call here, the demand story, macro headwinds. Heard about customers last quarter going down, seeking lower trims for cars that they wanted to buy. In the release, they mentioned that headwinds could include a mild recession in the U.S. and a moderate recession in Europe. Also want to look for pricing pressures. We saw the Mustang Mach-E have about a 10% price cut just this week, where we're going to see if they're going to actually potentially follow through with any more of those if they see customers balking at higher prices. So we'll keep an eye on that, and we'll look out for these things on the call. Back to you, Dave.
Yeah, let me just jump in here real quick, because when we talk about some of that demand story, some of that pricing story, when it comes to the supply chain issues, we know that has long been an issue here for a number of the automakers. Anything in this release that's showing that the fact that Ford is still struggling with that, or is that simply an issue of the past?
Last quarter they mentioned how they had about several thousand trucks waiting for chips to be installed, to be sent out. It does not appear that they have that issue this quarter. I have to dig a bit more closely into the release, but I did not see it on first blush. Hopefully we'll hear more about that on the call as well. But it seems they are having a better time or are able to actually make more trucks this quarter than the past.
Prost, this is still going to come down to the battery. Anything on the battery announcement front that we heard from Ford, either in this release or we expect to hear from them on the call? Because if you kind of point back to any of the earnings calls within the legacy automotive manufacturers, or even in the new kid on the block that is kind of riling everybody up, Tesla, it's all about the battery.
Yeah, we haven't heard anything here about anything amiss here in terms of production for Ford in 2023 and 2024. They're still on track. They're building these new factories in Kentucky to build these batteries. So I haven't heard anything about that. But recall that in GM's release this week, they talk about investing in the Lithium Americas mine. So they're talking about proactively or acquiring that material for their batteries. We're not seeing Ford say that just quite yet, but it sounds like they're on pace to hit their targets for EV production this year and the year after that.
All right, Praz, thanks so much for looking at shares off just about 6% in extended trading. Qualcomm is also moving after hours here. They are out with their fiscal first quarter results. You're looking at shares popping just about 2%. Ines Ferre has that for us. Hey, Ines.
Hey, Shauna, and it's mixed results for Qualcomm with a beat on the bottom line, adjusted earnings per share coming in at $2.37. The street was expecting $2.35. Meanwhile, adjusted revenue came in at $9.46 billion. The street was expecting $9.6 billion. So that's a miss. Qualcomm has seized second quarter revenue coming in anywhere between $8.7 billion and $9.5 billion. The street's expecting $9.58 billion, slight miss. And also Qualcomm saying that it's expecting demand and inventory to normalize in the second half of 2023. Some interesting commentary in the earnings release from Cristiano Amon, the president and CEO of Qualcomm, saying in a challenging environment, we delivered results consistent with guidance, including year-over-year growth in QCT, automotive, and IoT, Internet of Things. And remember that the smartphone industry has been slowing down. Qualcomm has been expanding into automotive, Internet of Things. So perhaps this is also why the stock is up right now. Automotive year-over-year growth at revenue was 58%. Internet of Things grew revenue by 7% year-over-year. So certainly expanding into automotive and Internet of Things, guys.
All right, Ines, thanks so much. Shares up nearly 2%. Well, coming up, our breakdown of big tech earnings continue. We will dive even deeper into Amazon's quarterly results after the break. Stick with us. Amazon shares now off just about 5.5% here in extended trading following its fourth quarter earnings results. Revenue did beat, but revenue guidance for the current quarter a bit lackluster. One of the reasons why we're seeing some pressure on the stock here after hours. Also, AWS revenue falling short of the street's expectations. We want to talk about it with Nick Jonas, JMP Securities equity research analyst. Nick, it's great to see you. So your first take on this report and the reaction that we're seeing in the stock in extended trading.
Yeah, so initially, the fourth quarter looked okay, top line beat, and then really operating income came in better than we and consensus were looking for. But where the disappointment really is in AWS performance. That came in a little lighter than expected. And as you kind of mentioned earlier, the outlook wasn't great. Now, I think top line missing a little bit with FX headwinds can be digested, but really it's on operating income. The street, we are looking for Amazon to control costs a little bit more. So definitely some bright spots on the fourth quarter. It looks like the early access Prime Day benefited third-party retail, but we're looking for stronger outlook. But it highlights kind of the tough macro environment we're in and these e-commerce companies and cloud companies are facing.
Andy Jassy's saying in the release, in the short term, we face an uncertain economy. We remain optimistic about the long-term opportunities for Amazon. What in this report surprised you most, Nick?
I was really pleased with 3P. I thought those sales were really strong. I think people were wondering whether or not the early access sales event would kind of work out for them. This first time ever they did a second Prime Day in 1 year. So I thought that was a bright spot, that's a tool that they have in their toolbox to kind of utilize their infrastructure better if they need to and really tap into that strong user base. Really, as we go into the call later tonight, I think the focus really is on what's the backlog number, what kind of commentary are we going to hear around AWS.
So within AWS, and I've been doing a kind of Control F or Command F for the Apple folks out there on all of these earnings reports on artificial intelligence and all of the claims that we're seeing pour in about how artificial intelligence is supposed to revolutionize some of the different products or solutions companies have. Amazon, they are certainly within that bunch as well here, saying that they're going to have AI within their intelligence models for AWS. What's the reality of that being a real needle mover for some of their portfolio clients?
I think it's tough to say today. As you see a lot of tech companies laying people off, making tech investments in new technology is clearly on the forefront, but maybe they're rationalizing a little bit more on really what's going to preserve costs and drive top line revenue. So I think long term, that's definitely a theme. Near term, I'm not sure it moves the needle.
Nick, what about some of those cost cutting efforts? We know that they are cutting 18,000 jobs, already started that. Is that enough to boost profits down the line, or do you think more action will be necessary?
They may need to take some more action. That said, Amazon has a long runway of growth ahead of them. So, they're balancing where their long-term vision is versus kind of what Wall Street's looking for near term. So, they're pleasantly surprised with operating income in 4Q. The 1Q guide, a little lighter than people were looking for. So would not be shocked to see more action taken later in the year, but it depends how the macro environment plays out here. That said, you really want to see Amazon continue to invest for future growth. There's still a lot of runway in AWS and cloud, and a lot of runway in retail, and a lot of runway in advertising.
Well, AWS, cloud, advertising, high margin businesses, retail, you look at the e-commerce figure and that came in slightly below some of the revenue estimates that were anticipated coming into this report. Is there anything that you can take out of this report and kind of apply to the mindset of the consumer right now?
Yeah, when you look at macro factors such as credit card debt, savings rates, kind of maybe leading indicators of where the discretionary spend is, it looks like it is starting to wind down a little bit. We even heard Meta talk about yesterday in advertising that, e-com is still declining year over year, but it's kind of improving. That said, it's still declining and maybe starting to stabilize. So it'll be interesting to see kind of how the consumers shake out, whether or not they still have, some dry powder in their pockets to go and spend on things across e-commerce.
Much publicized layoffs of 18,000, but they ramped up headcount 800,000 from 2019 to 2021. Do you expect to hear about further reductions?
Potentially. I think that's a factor. We could see the stock price. Investors were clearly looking for a better operating income guide into 1Q. But I'm going to go back to kind of what I said earlier. They need to make investments in advertising, cloud, continue to make investments in retail to continue to grow those businesses longer term versus kind of dealing with near-term pain. They have a strong balance sheet. They can navigate this. It's really just what the street wants out of Amazon today. All of that said, would not be surprised to see additional headcount reduction.
How significant is the continued loss on Rivian?
Near term, I don't know that it's that significant. I think most investors are kind of laser focused on operating income. It's definitely worth keeping an eye on, but it's a volatile market today, right? Stocks are down, and then kind of highly shorted stocks have all ran way up. Some are up 200% year to date. So that's going to be a volatile line item that we're going to monitor near term. I don't think it is a huge factor today.
100 million viewers worldwide for their first season of The Lord of the Rings, they touted. Why do I bring that up? Because of Amazon Prime and the, of course, ecosystem that they've tried to have scale across entertainment, across your purchasing at Whole Foods. But within that entertainment space, there's a lot of money that goes out the door to create some of these series here. Are you expecting Amazon, like some of the other streaming platforms, to have to kind of look through each of these titles and start to make some tough decisions about which ones they're going to prioritize going forward in the kind of restructuring of cost environment?
In this environment, absolutely. You have to think about spend on things like that. What's unique about Amazon, though, is that they are a retailer, whereas Netflix is not. So when you start to think about an advertising funnel and their freebie solution that they can offer, it could be a really compelling advertising platform.
We had a little bit of an audio issue there, but Brad, a lot to dissect there when you're getting to Amazon. We didn't get to break into. I'm curious about some things coming down the road. They're getting to the pharmacy business, gaming, air cargo service. Wanted to ask him which one of those Nick thinks will be the biggest provider down the road. You got some numbers coming?
Yeah, I got some numbers here from Apple. Let's take a look at the stock's reaction here after hours, and a very disappointing report. You can see that in the numbers here. Taking a look at sales, that missed expectations. 117.2 billion. The estimate out on the street was for 121.1 billion. EPS also coming in a bit light at $1.88. The estimate was for $1.94. So light there. iPhone revenue also a miss, 65.78 billion. Estimate was for 68.3 billion. iPad revenue was better than expected. One of the bright spots in this report. iPad revenue coming in 9.4 billion. Estimate was for 7.78 billion. Wearables 13.48 billion. Estimate out there was for 15.32 billion. Couple of other headlines here. Apple now has over 2 billion active devices as part of its installed base. We know China, obviously a huge focus here for the company. Greater China revenue, 23.91 billion. Estimate was for 21.8 billion. Services, a very huge focal point in this report. First quarter services revenue coming in at 20.77 billion. That was slightly better than the street's expectations at 20.47 billion. But that overall miss on the top and bottom lines, and the fact that iPhone revenue came in a bit light, 65.78 billion. Clearly a bit worrisome here for Apple headed forward and what that demand picture looks like.
Yeah, I mean, look, this is probably still, I think the characterization going in was best house in a bad neighborhood, cleanest dirty shirt, and I think that still pretty much holds for a quarter that we all expected to be down a little bit. iPad was expected to be the bright spot for Apple, and it was. We're not going to get a great look at the picture with the iPhone because the 14 had those production issues because of the shutdowns in China, so it's really going to be difficult to get a long-term read on where Apple's headed, because we know as bad as it got for smartphones, they increased their market share, and once those supply chains are fixed, might be a buying opportunity. Brad, what are you seeing?
Well, I was paying close attention to a few things, two of them in particular here, and I'm glad you mentioned that iPhone figure coming in lighter than expected here, because what that also signals that it's some of the core customers that Apple has gone after and relied on for these super cycles that are perhaps starting to push back on price. And you've seen that in other elements of retail. However, your phone is such an appendage that you carry around on a day in, day out basis. And if you see customers that are saying, you know what, my phone is just fine. The battery still cranking. Why do I need to upgrade right now? That is a pushback that Apple needs to be more concerned about, because then it impacts the pricing strategy, especially in some of the other regions that they're going to be monitoring. Now, that Greater China number that you mentioned, that sticks out as well, because that's a region that's going to have some stimulus that's getting pumped into the economy there. You had that Greater China number come in higher than anticipated, and the IMF has already signaled that the growth over the course of this year is going to be led in lion's share by what? India and China. And so any strength that you continue to see Apple hold on to within that region could be critical going forward from here. So those are two of the things that really stick out to me from this earnings. And as a person who's sitting here wearing an Apple Watch, that wearables figure, that also kind of jumped out to me a little bit here.
Me too. I am a huge believer in the Apple Watch. I have held those sales in the past, but some commentary here from Apple's CFO in this release about the economy, about supply chain issues, saying that we set an all-time revenue record, $20.8 billion there, but still, when we come to the fact that they did miss here, a challenging economic environment, Tim Cook illustrating that. They're also saying that production is now back to where we want it to be. So going forward, there are some concerns just about what exactly that demand picture is going to look like. But again, a huge concern here when you take into account what the economy, the current environment that we are in right now, what that iPhone revenue number could look like going forward. Yes, some of those production issues could be in the rear view mirror, but the demand story going forward, certainly something that Apple continues to worry about.
The look at the consumer, the look at the economy I was looking for to put either of you on the spot. Do we have a number on services? Because I think you're going to get a better indication there.
Yeah.
And then that services figure that Shauna mentioned earlier as well, $20.77 billion rounding there. And this is a part of the Apple business that's going to be slated to be eventually $100 billion run rate that they're trying to grow that out to as well here. So that's a big figure to keep your eye on. $80 billion is what we're getting close to here, and it was $50 billion back in 2020.
And that is a Tim Cook original, and that's where we thought we'd see a notable decline. You said 20.77, and the expectation was what?
The expectation was for that to come in at $20.46 billion for services.
Yeah, and going back to the quote that I was reading before my screen jumped off, the CFO saying that we set an all-time revenue record of $20.8 billion in that services business, and in spite of a difficult macroeconomic environment and the significant supply constraints, we grew total company revenue on a constant currency basis. So they're trying to spin that positive narrative here.
Absolutely. All right, guys. Well, coming up, shares of Apple, they're falling after a big miss on earnings. All of the big tech stocks are moving lower in after-hours trading on these reports. Stay tuned.
right, an earnings alert. Apple shares trading down just about 4% after earnings. For more on Apple, let's bring in Angelo Zeno, CFRA Research Senior Equity Analyst. Good to see you, sir. The headline for some, largest quarterly revenue decline since 2016. What is your headline?
Yeah, I mean, as far as Apple is concerned, right, I mean, I think we got to put it into context a little bit. We're talking about a revenue decline of about 5% on a year-over-year basis. But you kind of think about what's been going on within kind of the broader hardware space, right? In the December quarter, you're talking about PC sales in the broader PC market down 25 to 30% in the December quarter. You're talking about smartphone sales in the December quarter down about 15 to 20% overall. So when you kind of look at Apple's numbers here, I think we got about down 8% for iPhones. Definitely below expectations. But at the end of the day, I think to us, pretty much expected an unfavorable type of market in the December quarter as well as into the March quarter before things start improving. So not necessarily surprised by the weakness here. I do think the positive takeaway, I think you guys alluded to, was on the services side of things. That's a number you can trust because you're not worried about supply constraints necessarily there, right? So I think that is the positive takeaway to take here from the actual numbers.
Some of the takeaways from the release that came out, Angelo, navigating a challenging environment, saying that they had a difficult macroeconomic environment, significant supply chains that they're navigating as well right now. What is the tone that Tim Cook and the executive team needs to signal on the earnings call to really shore up or continue to shore up confidence in Apple in navigating this tough period?
Yeah, I think, listen, as far as the long term is concerned, I don't think there are many investors out there that are too concerned about Apple. I mean, clearly, what we do maybe want to get a little bit more clarity about is what the replacement cycle looks like right now, as we just kind of had two really great cycles with the rollout of 5G back with the iPhone 12 and 13. Now, when you kind of think about here, as far as the guidance is concerned and any type of commentary here in the near term, clearly investors want to know what's going on with the iPhone 14, especially the higher price devices on the pro side of things as we kind of go into the March quarter post supply constraints. So any type of clarity on that side of things, I think, is going to be very helpful and something that probably the stock is going to move on more than what we're seeing right now with the actual results.
And Angela, from your channel checks, from your analysis, what are you expecting there? Because clearly production issues, a massive headwind here for Apple in their very important holiday period. Going forward, though, do you think those consumers who weren't able to get their hands on phones, are they going to order in the current quarter, or are those just orders lost at this point?
So we don't necessarily think they're orders lost. But I think we're a little bit more conservative than the rest of the street is. I think we're about 2 to 3% below the street as far as the March quarter is concerned. Our view is there are probably going to be more consumers than they think that are probably going to hold off until the iPhone 15 cycle because some of the softness that's out there on the macro side of things, specifically out in Europe and even potentially out in China. So we think there are going to be some consumers out there that are willing to wait for the next iPhone 15 cycle.
Tim Cook telling CNBC 3 things really impacted the results: the strong dollar, the production issues out of China, and the macro environment. Which of those 3 do you think impacted the results the most, Angelo?
It's tough to really say. I mean, listen, they're all headwinds. I'd say the supply constraints out there, probably the biggest impact, and then, the macro factors out there. And I think just at the end of the day, it's really what the consumer is doing today, right? I mean, more consumers out there are clearly spending on experiences relative to actual hardware purchases. And we see it, just on the Mac numbers here. You're talking about a 29% decline year over year, clearly across very difficult comps out there. But when you start thinking about what's going on the broader side of things, not only Apple specific, there's clearly a shift in what's going on with the consumer. Now, you're going to get to see them lap some of these very difficult issues in the second half of this year, which is why we do like the stock right now, right? By the second half of this year, you're talking about a favorable Forex landscape. You're talking about easier comps as you lap some of the supply constraints right later this year that you just saw in the December quarter. So overall, I think the setup for Apple actually looks pretty favorable, and they're going to continue to be very aggressive with those buybacks, we're looking at an annual run rate of about $90 billion a year. We think they keep that in check when they report their March quarter results, later in a couple months.
It's hard to bet against Apple here going forward. Angela Zeno, always great to have you. Thanks so much. Well, coming up, Clorox trading higher on earnings, looking at gains at just about 3.5%. We'll tell you what other stocks are moving higher in after-hours trading. Stick with us.
Our earnings coverage continues now with Jared Blickery, who's here to see what stocks are moving after hours. What do we got, my friend?
That's right. We're looking at Microstrategy down 3.5%. We know this is Mr. Saylor's fund that is highly levered to the price of Bitcoin. So let me just skip to that part, then we'll get to the earnings. This is coming from the CFO. I am pleased to report we have increased our Bitcoin holdings this past quarter to a total of 132,500 Bitcoins. Our corporate strategy and conviction is acquiring, holding, and growing our Bitcoin positions for the long term, and that remains unchanged. Now, for those numbers, revenue was a small beat, 132.6 million for the quarter. That would be the fourth quarter. Estimates were for 131 million. Loss per share of $21.93 versus a loss per share of $8.43 a year ago. But again, don't pay too much attention to these numbers. It's really about the digital assets and any write-downs they have to take on their Bitcoin. So that's really where the profits and losses are coming from. Let's move on to Clorox.com, and we can see that stock is up about 3.37% in after-hours trading. I'll just put on a chart here. We can see very much going sideways over the last year. In fact, over the last 3 years, we've got a couple trading ranges going on. So let me get to those numbers. It looks like they boosted their full-year EPS forecast, and that's what's boosting the stock right now. Their year-long forecast, they're seeing adjusted EPS of $4.05 cents to 4.30. Previously, they saw 3.85, so they've moved that up. Estimate was 4.17, so it's right in the middle there. I'd say that met expectations. Also seeing organic sales 0 to 3%. The estimate was for just under 1%, so a little bit of a beat there, and seeing net sales of minus 2% to 1%. Now, in terms of some commentary, they're expecting cost savings of about $75 million to $100 million annually, with benefits of about $25 million in the fiscal year. Clorox is a company that had a lot of problems with margins recently, so they've gotten over that. Well, they're trying to get over that by cutting some of their costs here, and it would appear that they are getting incrementally positive on that front. Now I want to move on to Bill.com, and that stock is down about 20%, actually down extended. Let me just move this here. Bill.com is down 20% right now. This is over the last 3 years as well. You can see trading in a range similar to Clorox over the last year, but that big bump coming in late of 2021. Just a quick comment here on the third quarter forecast. They're seeing total revenue of 245 to 248 million. Estimate was for 251 million, so a little bit short of that. And is that enough for that big decline? Hard to say, but we're going to be waiting for some commentary on that on the call.
All right, thank you, Jared Blickery. Brad, what do you got?
The breaking news doesn't stop here on the 3 to 5. Kohl's just announcing interim CEO Tom Kingsburg is going to stay on as CEO permanently. He took over as interim CEO in December after former chief executive Michelle Gass decided to leave for Levi Strauss. Shares moving slightly lower on this news. Coming up, big tech earnings are coming to an end. We're going to tell you the biggest takeaways when we return. Tech stocks are in the red after earnings. Yahoo Finance's Dan Howley here with the biggest takeaways. Dan, perhaps we start with Apple and then what you took away from that on the earnings release here.
Let's go to it. I mean, the biggest, obviously, was that they saw revenue decline year over year. This is one of the biggest declines they've had in quite a while, the first they've had since 2019. I know we were expecting this, but still, iPhone sales, that's really what I'm looking at. That declined 8% year over year and missed analyst expectations. We had 65.7 billion on sales. Analysts were looking at 68.3 billion. Mac revenue, that was also off. We were expecting a miss for that to decline as well. Surprisingly, iPad revenue beat expectations, and so did services revenue, but that was just by a hair. So, you know, we were expecting this kind of problem with Apple because of the logistical challenges they had in China, as well as the softening demand for smartphones, but still 8% decline is pretty stark when it comes to this company.
Yeah, certainly. You see that concern reflected in the after-hours action right now. Dan, what about Amazon? Because AWS, a miss there, and clearly we're seeing that reflected in the stock off just about 3%.
Yeah, not surprising that AWS miss. It aligns with what we saw out of Microsoft, which also saw some softness on the side of its cloud networking infrastructure set up there. This just kind of continues that narrative of companies pulling back on spending in the prior quarter, you know, having to do with the rising interest rates. And, you know, I think the other issue, though, was how much money they actually lost for 2022 as a whole, $2.7 billion at Amazon. Absolutely wild from a company that, you know, essentially was dominating everything throughout the pandemic.
I thought, Dan, Amazon was going to give me a great look at the consumer. I don't necessarily see it in here. You know what I see that does tell me about the consumer? Starbucks. I hate to zag from the tech earnings. 10% U.S. same-store sales increase. 10%. That's against estimates of 9.26%. Average ticket up 9%. I'm sorry, to me, that is an overwhelming statement that the consumer is doing just fine. Am I wrong? Do you see something else in Amazon that tells you otherwise?
No, I mean, that is absolutely wild. I mean, I've actually, you know, first of all,
massive.
I'm a Dunkin' guy myself. Starbucks can kick rocks as far as I'm concerned. But
hot take.
I will say, the fact that people are spending more at Starbucks is crazy to me, especially, you know, when you think about the easier things that you can cut out. Yeah. Starbucks seems to be the one that I would think, and just go to Dunkin' instead.
And maybe we saw that a little bit with Apple services, pretty decent number as well.
Services, sticky right there in terms of how consumers are going to continue to buy into that different ecosystem that we were just talking about. Now that they've got a 2 billion install base across their products right now, that essentially, if you do some kind of back of the sheet math, that means every person that's got an iPhone probably has some other Apple device.
I'm one of those people. I think I have about 5 or 6 at home. And also, we haven't even mentioned Alphabet at this point. When you take into account some of the results there, the slowing down that we're seeing in the ad business, the movement that we're seeing in a lot of its competitors out there, clearly a worrisome sign here for Alphabet. But again, that stock off just about nearly 4%. Well, that'll do it for us today on Yahoo Finance Live. For more coverage on Apple's earnings report, be sure to tune in to the live special with our very own Brad Smith and Brian Sozzi after the earnings call this evening at 6 p.m. Eastern Time. And also be sure to come back tomorrow. We've got all the analysis carrying over into the next trading day. We'll see you tomorrow at 3 p.m. Eastern Time. Have a great night.